Welcome, everyone. We're doing another deep dive today, looking at that interesting intersection between global politics and the economy.
Exactly. And specifically, how the latest business and economic news often gets shaped, really, by political currents.
Today, we're zeroing in on the U.S. and China dynamic.
A big one, always.
Absolutely. We want to unpack a specific scenario. What if political friction leads China, which holds a lot of U.S. debt, to start selling off U.S. Treasury bonds?
It's a question with potentially huge implications, not just for Wall Street, but, for the wider U.S. economy.
Right. Things like borrowing costs, maybe even the housing market. It can touch everyday life.
For sure. But before we get into the what-ifs, maybe we should quickly touch on how Treasury bonds work. Just the basics.
Good idea, that price and yield thing.
Yeah, exactly. The key thing to remember is they move in opposite directions. If the price of a bond goes down,
Then the yield, the return you get, goes up.
precisely, it's an inverse relationship.
Okay, got it. So thinking about that, if China decides to sell a large amount of these bonds, what's the immediate market reaction?
Well, you'd suddenly have a lot more U.S. Treasuries hitting the market, increased supply.
And more supply usually pushes prices down.
Down, yes. Basic supply and demand. With prices falling, the yield has to go up to attract buyers for all those extra bonds.
So the U.S. government would effectively have to offer a better return on its debt.
That's the immediate mechanical effect, yes.
And China's role here is significant purely because of the scale of their holdings, right?
Absolutely. They're one of the biggest foreign holders of U.S. debt. We're not talking small change, so any big move they make, well, the market notices.
Okay, so China sells, supply goes up, price goes down, yield goes up. Now let's trace the ripple effects. Higher Treasury yields. What does that mean for the U.S. economy more broadly?
The first and most direct impact is on borrowing costs. For the U.S. government itself, it suddenly becomes more expensive to borrow money.
Which it does a lot of.
Which it does a lot of, yes. But it doesn't stop there. Treasury yields are like a benchmark.
Ah, so it affects other types of borrowing too.
Definitely. Think business loans. Companies looking to invest or expand might face higher interest rates on their borrowing.
Okay. And for regular people.
Same principle. You could see rates go up on things like credit cards, maybe car loans, other forms of consumer credit.
And I guess the big one people think about is mortgages and the housing market.
Yes, that's a really significant link. Mortgage rates tend to track pretty closely with Treasury yields.
So if Treasury yields rise, mortgage rates are likely to follow.
Very likely. And higher mortgage rates obviously make buying a home more expensive.
Which could cool down demand, potentially slow down the whole real estate sector.
It certainly could impact affordability. For someone maybe just managing to qualify for a loan, even a small rate increase can make a big difference.
Right. And connecting back to businesses, if their borrowing costs go up, what does that mean for growth and jobs?
Well, if capital becomes more expensive, businesses tend to become more cautious.
Makes sense.
They might delay investment plans, maybe put a pause on hiring, or in some cases even consider layoffs if things get tight.
So it could act as a drag on overall economic growth.
Yes, that's the potential downstream effect. Slower investment, slower hiring. It points towards a potential economic slowdown.
Beyond just a slowdown, is there a risk of, actual instability? Could a big sell-off spook the markets?
There's definitely potential for increased volatility, a sudden large dump of treasuries by a major player like China that could send ripples of uncertainty through the financial system.
Including the stock market.
Oh, absolutely. Investors might react negatively, shift assets around. It could lead to, jumpy markets, maybe even a significant sell-off if panic sets in.
Okay, so it sounds like a powerful tool China could potentially use.
Yeah.
But it's probably not that simple, is it? Are there risks for China in doing this?
Oh, absolutely. It's far from a risk-free move for them. It's actually quite complicated.
How so?
Well, for starters, think about what happens when they flood the market with treasuries. The price goes down, right?
Right, we established that.
But China still holds a massive amount of treasuries even after selling some. So by driving the price down, they're actually devaluing their own remaining assets.
Ah, so they'd be shooting themselves in the foot, financially speaking.
To some extent, yes. They'd be booking losses on their own holdings. That's a big disincentive.
What else?
Then there's the currency issue, the yuan. If they sell lots of dollar assets, the treasuries, and presumably convert that back into their own currency.
That increases demand for the yuan.
Exactly. Which would likely push the value of the yuan up against the dollar and other currencies?
And a stronger yuan makes Chinese exports more expensive for the rest of the world.
Precisely. Which could hurt their own export-driven economy. That's a major consideration for Beijing.
Okay, so hurting their own treasury values, potentially making their exports less competitive. Any other hurdles?
Well, yeah. Where would they put all that money? The U.S. Treasury market is kind of unique. It's incredibly large, incredibly liquid, meaning easy to buy and sell large amounts, and generally considered very safe.
There aren't many other places to park trillions of dollars with that same level of confidence.
Not really, not on that scale. Finding alternatives that are deep enough, liquid enough, and safe enough is a huge challenge.
And I imagine just the act of doing something so drastic would have global consequences.
Oh, for sure. A move like that could seriously destabilize global financial markets, not just U.S. markets, but everywhere.
Which wouldn't be good for China either, given their global investments.
Exactly. It could undermine global investor confidence, which makes everyone, including China. And then there's the diplomatic fallout.
Right. Using your treasury holdings as a weapon.
Doesn't usually win you many friends. It could provoke a strong reaction, maybe even sanctions or other retaliatory measures from the U.S. or allies.
So when you add it all up, it sounds less like a targeted weapon and more like mutually assured financial disruption.
That's a good way to put it. It really looks like a potential lose-lose scenario. Significant negative consequences for the U.S. economy, yes, but also pretty serious blowback for China's economy, too.
Which really brings home how intertwined these economies are and how important managing these financial relationships is. It's not just about trade talks.
Absolutely. Financial diplomacy, managing these huge capital flows and holdings, it's a critical piece of the puzzle alongside the more traditional diplomatic channels. Stability there benefit everyone.
So we've walked through this hypothetical but pretty significant scenario, a large-scale China sell-off of U.S. treasuries. It really shows how political tensions can echo through financial markets.
Mm-hmm. And how those echoes can reach pretty far, potentially impacting borrowing costs, your mortgage, maybe even the job market. Things that seem distant can actually be quite connected to our daily economic lives.
Definitely food for thought. If you found this deep dive interesting and want to explore more analyses on business, economics, and the political undercurrents, you can find more work from Frederick Griffin over at https://www.ghmanagementpartners.com. Just look for the Think Pieces section.
And thanks everyone for tuning in as we unpack this complex piece of the global economic picture.